to welcome new companies. And in fact, when you want to set up a company in France, you can do it globally in less than 1 week. And the global note that was given by this study from the World Bank was 93.1 for France for starting a business. The main question you will have to face are what is your legal status? Are you an independent worker? Do you want to build a company? Then you have to choose your tax status. Will your revenues be taxed under personal income tax or corporate tax? Is your activity professional or not professional? And you have to answer also questions about your social status. You can choose to be self-employed or an employed worker. And of course, it changes a lot to your social contributions and the pensions you can have when you retire. The first tax we'll speak about is corporate income tax. So the taxpayer is the company, and the taxation will be based on the net result determined by accounting books. So it is compulsory when you choose this tax to have accounting books. You have a series of tax credits which can apply. The main ones are to sustain researchers. So there are some special features for researchers as a crédit impôt recherche or a young innovative company. And these are the most common tax credits, and that cost a lot to the French state. The main rates for SMEs, for small and medium enterprises on this net result are 15%, with a threshold of net revenue of 38,120. And above that, the rate will be 26.5, and the trend is to go to 25. That is what is announced for 2022, but I don't know. It can change till the end of the year. So with the crisis, I don't know what will happen. Globally, the taxation of the dividends for the shareholders is 30%. This includes, as we'll see later, this includes CSG, which is a tax designed for financing the social system. Then the main, well, that's the personal income tax. In fact, it looks, many people tell us, oh, it is very complicated, it changes every year. In fact, in France, personal income tax was established in 1917. It was a tax to finance the war. So, and it has remained since so more than 1 century, and the basic rules are still in effect. So it shows it is not such a bad tax. Well, it has some logic. It is paid by physical persons only, and you'll have to pay it if your tax residence is in France. So tax residence in France, so the definition depends on the tax treaties with every country. Globally, if you spend more than 6 months in France, you will be considered as a tax resident. You will be also considered as a tax resident if your family is in France. Well, you can be considered as a tax resident if your family is in France, or if you have your main sources of revenues in France. There is no consideration of nationality to determine if you are a tax resident in France. That's the main law. But the tax treaty with the US makes sometimes there are some rules relating to the nationality of the taxpayer. There are many tax credits on this tax. So only 40% of the population in France pay effectively the personal income tax. So you have 60% chance. You have a 60% chance not to pay anything. And it is a progressive tax. That's very important. The rate goes from 0 to 45%, with some different levels at 11 and 30%. And if you have really high revenues of 250,000 euros for one person, then you have a temporary contribution for high revenues, which is 3 or 4%. It is temporary. It was set after the 2008 crisis, so it is temporary, but it has already it has about 10 years. And due to the COVID crisis, the temporary contribution could last quite a long time. What is very important for income tax in France, for the personal income tax, it depends, it is determined by household. So an household, basically it is 2 adults with children. So these adults must have a legal link, they can be married, they can have a PAX. And of course, due to the current forms of families, children can be only children of one parent. There are some options to include in this household the children from 18 till 25 years of age, especially if they are students, in fact. And your children can be in your household even though they don't live at the same address, or even though they are abroad. For example, you can, if you are in France and have some children who study in the US, they can be in your household. And the principle is that you have a globalization of the revenues inside. So all the revenues of the person of the household are totalized, and what you give to your children doesn't matter at all. And the chart I have put in the corner, in the lower corner. So for the same revenues, the difference when you have an household with one person, it is a red line, or when you have an household with 3 person, with 3 parts, that's an household with two children. And so it shows that there is a real difference in the taxes paid by the household, depending on its composition of people. What is taxable at the personal income tax? Globally, the rate of the Article 13 of the tax code is you take the gross revenues less the expenses to get your revenue or to keep it. So depending on the different sources of revenues, if you have wages or pensions, the sources of the information for the tax office will be the employer or the social bodies that pay the pension. If you have some investment income or capital gains, the information will be given by the bank. So globally, on these main sources of revenues, the tax office is directly informed about your revenues and will prepare a pre-filled tax return for you. On the other sources of revenues, then they need information from you. So if you have income from property, you have an accounting to make, and you have, if you have a professional activity with business profits or non-profit commercial profits or agricultural profits, then the sources of revenues will be accounting books that you have to report on your tax return. In all these cases, you have some simplifications which bear different names. but the measure of simplification is always the same. You don't need accounting books, but you will have a taxation based on your turnover. Then you have a rate representing your expenses. And this rate, for example, if you have real estate, will be 30%. If you are a micro entrepreneur, it can grow to 71%, representing your expenses. I must warn you that it is a simplification, but it doesn't mean it is a tax optimization, because under these simplified modes, as soon as you have €1 of revenue, you have €1 of taxable revenue. Whether with accounting books, you will count your real expenses, and maybe, for example, you have a deficit, and this deficit, maybe you can deduct it from the other revenues. So sometimes it is more effective to pay a chartered accountant and to lower your taxes, as the simplified mode is simplified but not optimized. And so you should make the difference for me. One of the main tax credits, if you live in France, is to hire some people at home, because a tax credit of 55% of the cost, and in fact it is to avoid that people are paid on the black market. Or are paid directly in cash and don't pay any social contribution or taxes. So the state is ready for an effort, and it creates some employment in the houses. So this tax credit is very common, and it can be used to get assistance or file your tax return. It is mainly used for housekeeping, gardening, and etc. And the services must be given by a registered company, by a licensed company. So about the revenues you could have from the US. Globally, the tax treaty with the US is designed for avoiding the double taxation of the revenue. So the rule should be that the revenue is to be taxed in the US or is to be taxed in France. The case of real estate is very simple. It is the rule worldwide for every country. The real estate is taxed where the real estate is. That is quite logical. So if you have some real estate in the US, you don't have anything to pay in France, it will be taxed under the US rules. And the reverse rule is the same. If you have some real estate in France, it is to be taxed in France. If you are a tax resident in France, then all your revenues must be declared in France, and you will have some mechanism of tax credits to avoid double taxation. So depending on the type of revenue, sometimes the tax credit will be equal to the taxation in France. So that means you won't have to pay anything. And there are some other cases where the tax credit is only equivalent to the taxes paid in the US. That's mainly the case with dividends, capital gains, or I would say the revenues from the financial sphere. And the rule will be globally to declare all your revenues in France. I would join myself to Darren when he was saying that the US tax department wanted to know your revenues, even though they are not taxed. The logic is more and more the same in France. So we will ask to declare all your bank accounts worldwide, all your life insurance contracts worldwide, etc. Not to tax them, but just to know where the money is and what people own. I wanted to make a point of about a tax which is Contribution Sociale Généralisée, so CSG. And in fact, it is a tax that was designed maybe 30 years ago to finance the social security system, as we couldn't increase the social contributions on the workers, and people were thinking that the people who owned some capital needed to finance the social security system. So the rate on activity revenues, that is wages or pension, is 9.70%, and on patrimonial revenues, it is real estate or financial capitals or dividends, it is 17.20%, and people often forget it. So that's why I point it. And it can, part of it can be deducted the following year for 6.8%. It's quite complicated. And yes, people forget it because in fact, we don't communicate so much on it. It exists, but people don't see it. For example, on salaries, it is global in the social contribution. So in the social contributions, so people only look at their net wages every month, but they have paid their CSG. And for dividends, there is a rate of 30%, which includes for more than the half the CSG. The other part would be the personal income tax. And if you have some real estate, etc., you will have an extra tax notice when you have in July. You will get your personal income tax, so the notification, the notice, and if you have some CSG on some revenues which didn't bear it, then you have an extra tax notice and to pay this. Another point in France, what exists in France is impôt sur la fortune immobilière. So that's on the real estate wealth. For people who are residents in France, it is based, well, first, when we say real estate, we consider real estate and companies where real estate are more than 50% of assets. And it is applicable if your real estate is more 1.3 million euros worth and more. So to determine your wealth, for residents, we'll consider the real estate worldwide, and for non-residents, the real estate in France. So if you are US tax residents and have, for example, some apartments in France, or one apartment in Paris, one nice apartment in Paris plus one house in Provence or something like that. Even though you are US tax resident, you may be subject to this tax, even though you don't pay in France any personal income tax. The rate goes from 0.5% to 1.5%. And you can have a tax credit if you pay the federal wealth tax in the US. So always the principle of double taxation, of avoiding the double taxation. There is France had a problem with Impatriates, so they built a special scheme to welcome the people from abroad. So in fact, if you are a company and you recruit a manager abroad to work in France, and under the condition that this manager has not lived in France for the 5 last years, then the employment contract should make a difference between the normal salary for the functions and an impatriation premium. And so the premium will not be taxed for 8 years under personal income tax. And for so for the wealth tax on real estate, then the rules for non-residents will apply. So only the real estate in France will be considered for calculating this tax and not the real estate in other countries. That's the main points I wanted to stress out to give you a very general view on some main taxes in France. And I'm ready with Darren to answer some of your questions.
All right. Thank you very much for that fantastic and comprehensive overview. For those who have been messaging, sorry, because we're live streaming this on other platforms, including Facebook and on YouTube and on LinkedIn. We did send a message. Hannah sent a message using the Eventbrite messaging function, and I also sent an email. So sorry you guys missed it, but I'm glad that you were able to view it on the other platforms. If you have questions as well, please put your questions in the chat box below, wherever it is that you're viewing the live stream, and I will pivot from Zoom and I will ask those questions once time permits. But we'll first address the questions in the order in which they were received. So those who emailed them ahead of time, we'll go with those first. So the first question is, I'm particularly interested in the tax treatment of Roth distributions in France, also rollovers from traditional to Roth, how are they treated? So essentially, just from a US perspective, the retirement plans fall into two very broad categories. I know I'm being really, really broad. There are those where you can pay the tax up front, like with a Roth, and you get the distribution upon retirement, more or less tax-free. And there are those where you get a tax deduction, so you're not paying tax on that income that's being invested. But whenever it is you do take a distribution upon retirement, that distribution will be subject to tax. So those are the two basic baskets. But the question is not on the US tax treatment, it's on the tax treatment in France. So, Hervé?
Yes, well, the main rule is that the US tax office, the French tax office are independent. So when you have a tax advantage in the US, you don't have any in France, and the contrary is the same. So, for example, for Roth distributions, viewed from France, it is purely a financial product that will produce dividends or capital gains. And then in the tax treaty between France and the US, there is a treatment of dividends, there is a treatment for capital gains, and there are no special mentions for some special products. So the rule is that when you are in France, if you are a tax resident in France, you will get the dividends, you will get the capital gains, and you will have a tax credit equivalent to the taxes paid in the US. The text doesn't say the taxes paid the same year. So maybe the taxes were paid, let's say, 15 years ago. I would say it is not illegal. The text doesn't say only the taxes paid the same year. So the principle, as I told you, the principle is your revenue, your taxable revenue in France, it is your revenue less all what you've paid to get it or to maintain it, to keep it. So the tax you paid in the US are deductible from you have a tax credit representing what you paid in the US to get this revenue.
Right. And I'm jumping slightly to another question that someone else asked. So they're asking whether pensions are taxable in the other countries. So if you have a US pension, would it be taxable in France? If you have a French pension, would it be taxable upon distribution from a US perspective? From a treaty, I guess they were referring to the tax treaty. Any comments on that?
The main rule when you consider your taxes in France is the first question is, are you a tax resident in France or not?
Yeah, right.
There are some rules that are defined by the French tax code. There are some rules that are given by the tax treaty. And then the first question is, are you a tax resident? If you are a tax resident in France, globally, you will have to consider all your revenues worldwide
Mhm.
and deduct tax credits representing the taxes paid in the US.
Okay, great. Moving on to question 2. Can you be considered a non-resident for tax purposes if your primary income is US based, such as rental income and retirement income, and still be a resident?
Oh, I don't know the tax treaty by heart, but globally the rule in France is if you spend more than 6 months in France
Mhm.
during the civil year from January to December, you are considered as a French tax resident.
Right. I think perhaps what this questioner may have in mind, because other European countries, like famously Spain has the Beckham rule, Portugal has the NRA, non-habitually resident NHR program. Both the UK and Ireland have res non-dom. So basically, these are tax structures that allow someone to live in their European country of choice, assuming they're not a citizen. So they live there, but they are not taxed on their income that arises outside of the European country of residence. Does a similar structure
The
exist in
main rule
France?
in France is if you are a tax resident in France, then you have to consider all your revenues worldwide. And then
Mhm.
the tax treaties with the US and other countries will apply and say where is the revenue to be taxed.
Mm.
And the main exception is real estate. When you have
Mhm.
if you are a tax resident in France and have real estate in Spain and US, etc., it won't be taxed in France. But that's
Mhm.
globally the main rule. Otherwise, you have tax credits to compensate the taxes you've paid in the other countries.
Okay, wonderful, perfect. Moving on, question 3. I'm a US taxpayer who's worked in France for many years and have now retired here. I have savings in a 401k, so a US pension structure from a previous job in the US and in similar plans, PERCO and PAA, sponsored by employers in France. I know that under the US French tax treaty, when I take a distribution from the 401k, the US retirement plan, I declare it in both countries, but France does not tax it. So I guess that's a statement and they're looking for some sort of confirmation. Any comments?
In the French law doesn't know what a 401k is.
Mhm.
Even though it looks like a French financial product like Perco and PE, it is not known in France as such. So for the French side, it is an account with a capital that produces interest and capital gains or pensions, and they are to be taxed under these rules. There are no there are no special rules for that. Yeah.
Okay, right. Understood. Understood. So let's move on. Number 4. What about distribution from the Perco or PAA? I will not owe any French income tax on these, only social charges because my contributions to these plans were not tax deductible. So they were after tax, I guess, right? However, if I declare PAA and PERCO distributions on my US Form 1040, presumably I'll have to pay US taxes on them, though I know I can get a tax credit. Uh, blah, blah, blah. Okay. So from a US perspective, it is exactly the opposite of what Hervé just said. So you'll declare it on your US tax forms and you get tax credits for it. So the bottom line is that it'll be unusual for someone to be double taxed because of the principle of foreign tax credits as well as the ability to apply the treaty. So moving on. Number 5, my question is, how will you serve the clients residing in the US? So I guess somebody's still in the US who are involved in international and national trade if they were to retain our firm. I'm about to enter the market and in the process of doing research. Okay, so I guess someone is in the US, they have some sort of business idea, and they're looking for help or from assistance from a tax or accounting perspective, we can definitely help you. We have quite a number of clients who run their own businesses or have substantial shares in businesses that do cross-border transactions. What we'll need to do typically is have an introductory call on Zoom, but we need to see a business plan. So we need to understand exactly what are the jurisdictions in play, where the shareholders, what is the nature of the product or service, what does the supply chain look like, where the key personnel based. So we're looking for what we call permanent establishment and therefore cross-border tax issues. So typically when we see a decent business plan, we get a sense for what the scope is and we can talk it through and clarify stuff on a Zoom call. And then we'll be able to give you a quote for assisting you in any way in which you believe or that you require assistance. That's no problem at all. Just shoot me an email and we can take it from there. Next question. I'm a US taxpayer, recently retired in France after working a number of years in France. My French employer offered a PERCO retirement plan that I contributed to. My contributions were not tax deductible, and I've been told that when I take distributions from the plan, they will not be subject to French income tax, only social charges. Is that correct, Hervé?
So, as far as I know, you have two ways to use a PERCO. When you retire, you choose whether you want immediately capital and get back all your money, or you choose to get a pension every month for the rest of your life. If you want to get a pension, a regular pension, then it is taxed to the French income tax with some reduced rates depending on your age when you retire or when you break the plan. But if you want to get the capital, you will pay only CSJ, so 17.2%. And then you'll get your capital. But when your capital will produce some interest or some capital gains, then you'll pay the income tax.
Okay, understood. And there's a follow-up question in there. And will my PERCO distributions be subject to U.S. income tax? It really depends. If it is that it is truly deemed to be a pension, then typically it's only taxable in France. Uh, Alternatively, even if it may be taxable to the US, you will get credits for any tax that has been paid on that money. So I guess if it were not to be deemed to be a pension, we'd need to bifurcate the sums or the investment and understand what portion of it is the what we call in US taxes corpus, or the original investment, which is after tax income, so that's already been taxed, and what portion of it is a gain, so whether it's a capital gains or dividends, and we'll need to treat each of those accordingly. So stepping back, the answer is you're not going to be taxed twice because of the principle of tax credits, which we've explained a little bit earlier, as well as the ability to apply the treaty. So I think that's what most people are worried about, as you can see from the questions. So I'm scrolling down some more, and I think there's one more question. I filed my French tax declaration jointly with my French husband, who has never lived in the US. What are his tax responsibilities towards the Internal Revenue Service? Well, as Hervé pointed out at the beginning, the French tax process is completely separate from the US one. So just because you file jointly in France doesn't necessarily mean that the implications from a US perspective, you're not required to file jointly. If you are US exposed and you're married to someone who's not US exposed, in this case, they're just 100% French, then you can file marriage separately, in which case your spouse's financial situation is in no way exposed to the Internal Revenue Service. So it's just your situation only, except where you may have joint assets. So if you have like a joint investment account, or then that will be obviously declared. And if it's 50-50, then you just pay tax on your portion. Or if there are joint financial assets. So for example, joint accounts, because remember there are those asset declarations where you declare certain like insurance policies with cash in it, or brokerage accounts, or just regular bank accounts, savings accounts, or whatever. If it's joint with your spouse, then it's a joint asset. So it's going to be on that asset declaration form, whether it's a FBAR or foreign bank account report, or the Form 8938 or 8621 if it's an investment structure. So it will be declared, but his portion of the returns of whatever your spouse's, his or her, return on that investment should not be subject to US taxes. So don't worry, your non-US spouses investments are not going to be exposed to the US tax system. I know that's your concern. I'm going to flip over to some of the other platforms to see whether there are any questions. And I think we're okay, right? Yep. Okay, so on that note, thank you very much for logging in and attending and submitting your questions. Please, if you need to be in touch with us, I believe that, yes, Hannah put our contact details in the chat box below, and Ervish, he flashed his contact details as well. This entire session has been recorded and will be available on our website, hug.tax, as well as on our Facebook page, on YouTube, and on the other podcast platforms, iTunes, SoundCloud, wherever it is you get your podcasts, this will be available. Feel free to reach out to us if you need our help. Otherwise, we'll see you next time. Thank you. Bye-bye.